Please start. Great. Good morning. This is the New York City Fire Pension Fund investment meeting. We are here at One Battery Plaza in the 9th floor conference room. This is a hybrid meeting with some attendees participating via Zoom. Today is June 17th, 2024. It is 10:02 a.m. Mr. McGinnis, will you please take a roll call?
Certainly. Good morning, everybody. Representing Mayor Eric Adams.
Kevin Liu, President for Mayor Adams.
One Kevin. Representing Controller Brad Lander.
John Dorset, designee for Control, Bradley.
Very good. Representing Commissioner of Finance Preston Niblock. Good morning, Nadia. Representing the UFA, Mr. Andrew Ansborough.
Bobby Eustace with Andy Ansboro's proxy.
Good morning, Bobby. And Robert Eustace.
Present.
Mr. Christopher Viola.
Present.
Mr. Dennis Tavetta.
Present.
Mr. John Young.
Present.
Representing the UFOA, Mr. Joseph Camastro.
Here.
Mr. Liam Guilfoyle.
Here.
Mr. Sean Michael.
Here.
And representing Fire Commissioner Laura Kavanaugh, Deputy Commissioner Lizette Christoph.
Here.
We have a quorum.
Excellent. Thank you. We will start with the public agenda. I will turn it over to the Controller's office.
Great, thank you very much. So good morning, all. Welcome to today's meeting. We have a couple of items that we're going to discuss in public session, and then what I hope is a concise agenda in executive. So the first item that we have on the agenda is the holdover item from last month, which is the STAR recommendation. We are going to leave that on there as we continue to discuss with trustees the proposal. We'll leave it on today in case there are any specific questions. If not, we can always address those between meetings. But that will remain on the calendar until we come to a resolution. So the next item on the agenda is the quarterly presentation. There are two components to this. One is the market update provided by Steve Meyer. Steve is on the train. There is some delays. So we're going to switch the order a little bit. We're going to turn it over to Ed Berman to talk to us about the risk presentation, which you can find and follow along with in Convene. And there will also be some slides on the screen. So Ed, take it away.
Thank you, John. Good morning, everyone. Please have the first page of the presentation. Okay, thank you. Yeah, so we're going slightly out of order, so first of all, I want to say that the last quarter was truly extraordinary. I would say it's probably as good as it gets. The CPI is running around 3.3%. The PC, which is the Fed preferred measure, is between 2 and 3%, essentially at target. Unemployment is low. Job openings are healthy. It's really as good as it gets. At the same time, markets delivered completely outstanding. It's good all over. Japan is doing well. Europe is doing well. China is doing maybe less well. But domestic market just completely through the roof. Just the S&P delivered an 11% return against 11% volatility. That's a Sharpe ratio of 2.0. So the long-term Sharpe ratio of U.S. equities is about 0.4. At 2.0, let's say maybe a little bit too good to be true. Like, how long will it last? And that's why it kind of trying to send you kind of message or frame your expectations around the risk in the portfolio. Obviously, markets move in and out. It's probably likely to expect some turbulent times ahead. And what we'll try to address today is how well your portfolio performed in the past quarter, and of course, looking forward. So when you think about risk to the portfolio, really just two things you kind of need to keep in focus. So one is volatility. You see it on the screen right now. On the left-hand side, it's the VIX index, volatility of equities. On the right-hand side, MOVE, which is volatility of fixed income. When I say volatility, all I really mean is just how fast prices are moving up or down. Right? And the way these charts are set up, the bottom of the chart shows when everything is absolutely perfect, nothing will ever go wrong. This is as low as it gets. The upper end shows close to panic. And you can see that the VIX index over the past year has been moving down, down, and down. And for the previous quarter, close to 14%, 14 points. Basically, the market sending you a message that all is well and nothing will ever go wrong. Nothing to worry about. You look at the move index on the right hand side, a little bit different messaging, different framing. So if the bottom is all is well, the top range is panic. We started neither panic, neither well, somewhere in the middle. Moving closer to things are better, but we're not out of the woods. So the bottom line, equities, perfect. Fixed income, still having some concerns. But the second factor you need to keep in focus, and probably I would argue even more important than volatility. If the next page, please. Thank you. It's the stock bond correlation. And what I mean by that is the relationship between the stock prices and bond prices. Positive correlation means they move together. Stock prices go up, bond prices go up again. It sounds well, obviously portfolio benefits. The problem is it increases the chances of drawdown. And drawdowns, probably the worst thing that may happen to multi-asset portfolio. It's very hard to recover from the drawdown. That's exactly the point of having the negative stock bond correlation, which provides you a natural diversification and hedging in your portfolio. So where does it stand? And we talked about last quarter, last meeting, this very clear dependence on inflation. So you see inflation since about 2003 on the right-hand side. And there are three very distinct regimes. Before the global financial crisis, before 2008, inflation ran a little bit above 3%, which is roughly where we're at today, actually. It was considered normal level of inflation. And the stock bond correlation was negative, about 25%. You can see it on the left. After the global financial crisis, inflation moved lower. Stock bond correlation moved down, minus 0.36. And of course, now with structurally high inflation regime, stock bond correlation is positive. So what's interesting, we talked about last time, but look what happened last quarter. You can see it on the chart on the left. The stock bond correlation went up to 0.52. It's a fairly high level. Let me just put it in the context and explain what it means for your portfolio. So first of all, let's put this number in the long-term perspective. Can we have next page, please? Thank you. And yeah, we looked at it last time, but I think it's important to keep it in focus. So the correlation of 0.5 is actually not that far from the long-term range. So here you see the stock bond correlation since the beginning of the 20th century, a little bit more than 100 years. And 0.5 is not so much unheard of. It's a high level. But the correlation tends to stay positive over most of the 20th century. Why does it matter? And what it means for your portfolio? So on the next page, thank you. We show what's called efficient frontier, and it's just a fancy word for a simple chart that plots volatility against the return. Right, so at the top of it, we have 100% stock portfolio, 100% of S&P. At the bottom, you see 100% bond portfolio, 100% US Treasury 10-year, and anything in between are different plans. So the yellow line that curves a lot assumes the correlation negative, minus 30%. The red line, which is more straight line, shows a correlation of 0.3. And you can see now what it means for your portfolio. So the assumption is we need to achieve a 7% return with a negative stock bond correlation. The 7% return is achieved at a 5% volatility. Correlation goes higher, gold goes higher as well. So that brings a very interesting trade-off for your portfolio. It's a trade-off between risk and return. We can achieve the same 7% return at the expense of a much higher risk, meaning higher drawdowns, chance of a drawdown. Or we can stay with the same risk level, but then the returns will be low. So what can be done about it? You actually already have a fairly strong diversifying your portfolio. It's private assets. Private assets provide uncorrelated returns. They move to a different cycle from public markets. This diversification is real, but it plays out usually on the scale of months and quarters. Like if you step back from the perspective of 1, 2, 3 years, this protection probably will not be as effective as over long term. Private markets to be more aligned with public markets. You also have in your hedge fund portfolio, you have macro hedge funds. It's a fairly small allocation, but it's one of the kind of classical prescription for the positive stop-band correlation that we want the levers that we can pull and address it. Some solutions probably will not be consistent with your philosophy, like gold is usually quoted as a good diversified. I wouldn't suggest it. And something we considered during the essay strategic asset allocation for the teacher's portfolio, adding the trend following strategies. It's again something we can explore and there are ways to address it. So it's something we keep in mind and keep in focus. It's I would say one of the important risks to your portfolio that would track. And if it structurally shifts higher, we'll be talking about how to address it. So with this long introduction, what are the risks of your portfolio? How did your portfolio perform in the last quarter? The next page, please. Thank you. And again, just to remind you, when we talk about risks, I almost use interchangeably, risks and performance. And that's all that risk is the expectation of the future performance within certain probability. So you can see risks on the table on this page, and your portfolio ran at risk of 10.5%, which means that we expect the performance, the total return of your portfolio, the next 12 months to be within this range of 10.5%. So again, a lot goes into this number. You have a big portfolio, close to 500 managers. So I cannot pretend they cover everything in 10 minutes. But to put it in perspective, like really high level checkpoint in your portfolio, starting with markets, column 1. Here we show just a simple 65-35 blend. You can see that the risk for this blend was 10.6%. That's the market level. It's down about 60 basis points, consistent with what we talked about. Volatility levels are down. Your benchmark, column number 2, is consistent with markets at 9.6%, also down. You notice the benchmark runs a slightly low risk level. That's a result of the asset allocation, additional diversification across several asset classes. And finally, your portfolio 10.5% total risk, again, consistent with the markets. It's down about 30 basis points. So no big changes. And again, much like we talk about two levels of performance, this total return and this active return, excess return, which is the skill of your managers. Much the same, we talk about active risk, which is a measure of the future excess returns. It's 1.8%. It's almost unchanged from before. So from the highest vantage point, your portfolio performs within expectations, the risk as expected. So what's going like slight under the hood? Let's start with the total risk measure. Okay, next page. Okay, so just as we said, total risk in your portfolio runs at 10.5%, which is a measure of your expected performance. So here we show two views on your asset allocation. On the left-hand side, it's the strategic asset allocation in terms of market value. This is the last time I'm showing you the old SAA, because now we shifted to the new allocation from the previous year. And you can see it's a 45% allocation to public equities, 26% allocation to alternatives. I'm not going to read the numbers. On the right-hand side, you see what we call risk allocation. These are really the components of your total risk. That gives you the expectation how your portfolio will perform in terms of returns, and also in terms of potential drawdowns. Clearly, equities are much more important than asset allocation would imply. So you can see just looking at public equities plus private equity, it's 81%. That's before we take equity allocation from the hedge funds, infrastructure, some exposure in real estate. So clearly, equity is the most important for your portfolio. That's what determines your risks. And it's an important number to keep in mind. And much like before, we kind of benchmark risk with returns, which I say risk and returns are the same thing. We are very related. So we look how, get the next page, please. Okay. So we look how the realized performance compares with the forecasted risks. The reason we do that it's not just simple check on the model, which it is. It's a check on your asset allocation, check on your asset classes, check on your managers. That will show if something unusual is happening in the portfolio. And the answer here is very simple. Nothing unusual is going on. So it's a boring conclusion, which I'm sure you don't mind. That's not all the place for side presentation. So starting with chart number one, the highest level view, clearly your portfolio level SPY is well within range, all asset classes all within the range. Probably the only place where you see a little bit of action, chart number three, public equities. In the US equities, the returns slightly exceeded forecast. This again the result of how unusual this quarter was. I wish I could say good times will continue. I'm a risk manager, a little skeptical. But clearly extraordinary quarter, extraordinary returns. But you can see how risk levels frame the return expectations. Fixed income, low risks, low returns. You see that core fixed income delivered a negative return, high yield positive return. Simply kind of push-pull that played out in the fixed income markets. Rates went higher. So the 2-year treasury moved from 4.35%, which is negative for fixed income market. At the same time, spreads moved down. So high yield spread moved from 370 to 340, which is positive. So which explains why core fixed income slightly negative return, high yield slightly positive. But again, all within expectations, nothing unusual. So no big takeaways, which again is not a bad outcome. So the second measure of risk, we'll talk about active risk. Give it the next page. Thank you. And again, active risk is just a measure of your expected future excess return. That's the skill of your managers. So the active risk in your portfolio runs at 1.8%, slightly down from the quarter before. And here we show how this risk in your portfolio evolves over the time, and also the components of risk. It's not surprising that private assets take a lion's share of active risk, and simply because we know that private assets are different from public assets. The benchmarks are not exactly comparable. There will be a big difference how they evolve. We see it playing out all the time. Maybe what's more interesting here is that the contribution of public assets to active risk is fairly low. Yeah, we're talking about last quarter. So this public fixed income contributes only 10 basis points. Public equity is about 20 basis points. So both of these asset classes are in scope within BAM. They're subject to ongoing projects. Would say public equity is probably more advanced. So with what your consultant was Doc, and some people talking to you about it sometime in the future.
Yes. How does what we're hearing, higher interest rates affect ability for us to out that hearing private equities have so interest rates is then that
I can actually address this question, but today we have privilege of Nash, the role. Maybe one comment.
curious if it is, but
I just want to remind, we have a session in executive that may touch upon this.
Wait.
So if there's a broad question, I just want to remind folks that we shouldn't get into the depths of our actual portfolio in public session.
I get it.
Yeah.
So historically, in better markets, what you saw is roughly 20% of your portfolio would be distributed any given year. And in recent times, it's slowed down to about 10%. So exits are still happening, but there are fewer of them. Most of the companies that are being exited are higher quality businesses. And the implication is that you're going to see longer holding periods for these companies. As interest rates have stopped increasing, they sort of stabilized. That has increased exit activity a little bit. So private equity managers are now feeling more comfortable bringing more of their companies for sale than they were last year. And there's obviously a lot of pressure from their LPs to start selling those assets. So we're seeing more of that. We've even seen an IPO, and a couple of them start. There was one IPO of a EQT company 2 weeks ago, which did really well. And so I think we're going to start seeing more of that, a little bit, slower coming in. But in terms of what risk does that put on your portfolio, I think you have to contextualize the fact that your public equity book is about 6 times the size of your private equity book. So even though you've increased that target a little bit more recently, which is going to be helpful for you in terms of buying new assets going forward, it's still a much, much smaller proportion than your overall public equity book.
I would also add to that private equity tends to play out over a longer period of time. And it's probably not so unexpected that a somewhat peculiar macro environment, post-pandemic, the war, everything, put some pressure on private equity. But again, wouldn't necessarily draw conclusions from one of them. And we'll see in a second some of these conclusions, so if they jump potentially from the page, if somewhat misleading, but for the next page. Next page, please, if possible. Thank you. So to Liam's point, which may look like scary, but I would argue somewhat misleading. So here we compare excess return against the risk projection. It's the same exercise as we talked in terms of total risk, except here excess returns. That's a measure on your managers. That's where you can see anything is happening at a very high level, of course, but anything unusual is happening within managers will pop up on this page. And obviously, one thing that jumps off the page here is a private equity, chart number 2, which shows a hugely negative return, which again, I would say somewhat misleading. It's not that private equity delivered a negative return, just didn't keep up with public markets for the quarter. Again, going back to my point that public markets delivered completely an outstanding through the roof performance. So it's not surprising that this quarter just optically doesn't look. Again, I have nothing to worry about here. Probably the only thing that stands out a little bit on this page, chart number 3, public equities. We look at developed ex-US, which I would say probably the biggest success story in equities. It's the additional allocation delivered a long-term positive return for more than 10 years. This quarter was not as positive. You can see the negative excess return minus 1.2. And there's also a little bit somewhat technical. We'll look into this. To put technical term on it, the manager's loss on the momentum factor. And what I mean by that, markets moved very strong and very fast. Market trended in one direction, and the active managers were not positioned for this development. Again, very unusual markets, so they underperformed. But what's interesting that almost all of your managers delivered comparable performance in this momentum factor. In terms of fixed income returns, again, as I keep saying that the level of risk should frame expectation for returns. The risk levels are low. You see the returns also not very high. But again, the broad message here, everything is consistent, and can imagine functioning within the guidelines. Internally within FAM, we'll look at it much deeper level. We'll go down to individual managers, positions, help with the managers. So we'll be happy to discuss it at some point more deeply. So we talked about the past quarter. Probably the more important question is about the future. How will your portfolio perform in times to come? Can we have the next page, please? Thank you. And again, it's the same structure we talked about the previous last quarter, so I'm not going to spend much time on it. But broadly speaking, the world is completely unpredictable, and I can tell you otherwise, probably misleading. But we look at 3 main dimensions of market and economy, obviously equities, rates, and commodities. So clearly your portfolio has no explicit exposure to commodities. You're not holding any commodity managers or commodities directly, but you cannot escape their influence because commodities are the bloodstream of the economy. Require everything that's being produced requires commodity prices. And I just want to highlight 2 charts for you here. So first of all, chart number 7 in the bottom left, copper. And copper is a very interesting product. Some people don't talk much about it, but copper goes in pretty much anything. Construction requires copper, cars require copper, artificial intelligence requires copper. And you can see here that our risk system projected that copper prices from about 400 will go up to about 514 or down to 87. As it happens, since we produced these charts at the end of the quarter, copper prices went almost to the very top of the range. Copper price closed at 512. It is back a little bit. There are several reasons why copper moved so much higher, and I'll explain in a second why I focus so much on copper. Part of it is China. As China ramping up their manufacturing, their export demand for copper increases. Part of it is just the AI story. You can see that the chips are through the roof. Chips require copper. But the reason copper is important, and the reason I highlighted today, copper is highly correlated with inflation. You can see it in chart number 9. It's almost like copper is a forerunner of inflation. It's almost like a leading indicator. So any change in copper price may signal that economy is running hotter than expected. This may delay the Federal Reserve from cutting rates. And the rates are staying high. You can see chart number 4. The rates are very high. Why it is important? The short answer, it's the debt level. Go to the next page. Thank you. So this is a chart from the IMF that shows the trends in the global debt level as percentage of GDP. And this lot of talk and will focus on the level of public debt, meaning treasury level. And yes, it's something we should keep in focus. The treasury level runs over 5% GDP. But first, I tend to focus more on the private debt. So the treasury issues a lot of debt, but they actually can issue its own currency, can always service our debt. Private debt is a problem. And you can see here that private debt currently stands about 146%. But putting it back, going back to the previous crisis, the global financial crisis. So back in 2007, the total debt level stood at 193%. At the same time, the interest rates that the treasury considered on the right stood at 4.3%. Fast forward several years, right now, the global debt level is pushing 250%. At the end of last year, it was 226, much higher. The rates, 4.6%, slightly higher again. So that's a very unstable relationship. Something may break. Things broke in 2008, as we know. I'm not forecasting the same. Actually, I would think it's unlikely to happen again anytime soon. What may happen are the problems brought. So more likely, problems will come from outside the United States. The IMF estimates about 70 countries, about half of all countries, on the risk of defaults. Several defaults already happened, like Zimbabwe, a few other countries. But high level of debt combined with high interest rates, combined with US dollar, the historically high. The dollar has been that high only in the 80s, mid-1980s. It spells out potential problems. So we're looking at potential turbulent markets ahead of us. Problem could be with equities, which are very high, but it's more likely at that level may trigger some financial crisis. So how will your portfolio perform in this environment? What is your expectation? Go to the next page, please. So here again, we show the same 9 scenarios. They show level of shock. And the important thing to keep in mind, so these shocks, these scenarios are equally likely. That's when you look at the response of your portfolio in column number 1, absolute returns, kind of gauge the impact of the shock on your portfolio. And clearly, the S&P 500 is the largest impact. We'll talk about equity being the biggest contributor to the risk and the returns. It's also not surprising that US markets dominate so much. But focus on line number 7, copper, and line number 6, the FX rate. Your portfolio will benefit from copper price appreciation. It will benefit from a decline in the US dollar. So your portfolio is positioned pro-risk, pro-cyclical, will benefit from the expansion. And of course, the opposite is true. In a slowdown, it will perform like the less. The important thing we'll keep in focus is so-called convexity, which is just a fancy word of saying that your returns are not symmetric. You can see that your portfolio makes more in risk on than losing in risk off. It's a result of your asset allocation. It's a positive outcome, something we track. It's a good result. The last point I want to make on this page, column number 2, excess returns. So you'll notice that essentially across all scenarios, all projections, your portfolio will deliver a positive excess return in the risk-on environment. Unfortunately, in the risk-off environment, it'll probably underperform the benchmark. It's not necessarily a bad exposure to have. Markets tend to go higher more than go down. But at the same time, the expectation is if we're hitting turbulent time, the portfolio may underperform. Okay, so stop here and pause for any questions.
Thank you, Ed. Don't know what you heard. Steve's joined us today. And Steve, we bypassed the market update in order to do risk first. So if you'd like to give us a
Yeah. Terrific, John. And thank you for those kind words and that warm welcome. Again, trustees, I am,
defended you, just so you know, when John was all over you, we were really defending you.
believe it or not, it took me almost 15 minutes to get here on a subway, but I could walk backwards faster. Anyway, so I thought Ed's presentation was terrific. I thought Anash's comments around private equity were dead on. I'm going to try to keep this higher level. I want the trustees to know I was working on this last night. I've got it down to about an hour. But I'll give you the Reader's Digest version, maybe a quick, just 15 minutes. Before we get into any of the slides, just remember, we always talk about quarterly performance. I come in here on a monthly basis as well. We really focus on those longer themes that are going to impact your portfolio over time. Deglobalization, the demographic changes and the impact on labor, the digitalization. I think right now we're in an artificial intelligence investment super cycle, which is really just interesting to see how it plays out. Touch on some of Ed's themes, the debt level, the sovereign debt levels out there, I think are some of the things we need to consider in terms of the impact, not just risk, but also potential cost of capital. And all that is wrapped in a nice, neat bow of geopolitical risk, which is elevated. It seems to be discounted by the market at this point. The reason why we look at these things, we try to get a sense for what is going to happen to GDP growth here and abroad over the next 10 years. What's the impact on inflation and what's the impact on productivity? So I'll try to tie it all together. Maybe just the next slide, first slide, Kate. Just a look at just in terms of inflation. So the disinflationary trend that we saw starting in, say, the middle part of 2023 is still intact. Inflation continues to move lower at a jerky pace. We had a little bit of a backup in inflation levels here in the States in the first quarter, but they've resumed their downtrend both here and abroad. Maybe the next slide, Kate. Just a look at how that looks like on a graph. You can see in the white, that is the CPI level, which rounds up to 3.3% for the month of May. Just by way of memory, January, we saw 3.1% CPI. February moved higher, 3.2%. March moved even higher, 3.5%. That's why the market was a little spooked and sold off, particularly in bonds. April came in at 3.4%, now May at 3.3%. So that disinflationary trend is still intact. On the next slide, I'll look at those three big economies, the US, the Eurozone, and the smaller one, the UK, in gray. You can see on the right-hand side of this chart, obviously a ramp up in inflation, peaking in the States in June of 2023 and coming down, 22, coming down from over 9%. But if you look on the far right-hand side, it does look as though it's flattened out a little bit. And if you really look closely at the red bar, you can see that, again, we have had a little bit more positive momentum on the downside, on which the market likes. I think the Fed likes as well. On the next slide, just in terms of labor, our labor market continues to remain incredibly strong, perhaps stronger than the Fed would like to see. May's non-farm payroll report came in. It was expected to show 185,000 jobs created. It showed a whopping 272,000 jobs created. Wages were up more than expected, and on the alternative side, unemployment actually went from 3.9% up to 4.0%. So still very, very low levels of unemployment, and the economy seems to be able to produce and absorb labor at a pretty good clip. On the next slide, one of the things I talked about, demographics and the impact on labor force dynamics. Look at the yellow line up top. That's the labor participation rate. It's still about 100 basis points or 1% below where it was pre-pandemic. And that has to do with people that are a little older in their 60s and getting retirement age, a lot of whom retired probably a little earlier than they would have anticipated given the pandemic. So we haven't gotten to that level. And again, it's also important to know, maybe I'll call attention, this is a 10-year chart, but I'm trying to provide more of that historical perspective to get a sense for where we've been, the volatility, extraordinary levels of volatility we saw in labor and other areas of the economy during the pandemic, where we are today. On the next slide, U.S. economic growth is slowing, but still is moderately okay. Our economy has been incredibly resilient. Our first quarter GDP initial estimate came in around a little less than 1% and revised up to 1.3%. And we're probably looking at economic growth for the full year 2024, around 2.3, 2.4%, so slightly above trend, and certainly not bad, particularly given the fact that the Fed has been aggressive in raising rates, at least up until July of last year. We do have some challenges. We have existing home sales are lower. Home buying is down because of higher rates and the less availability of supply. And that is having an impact on consumer spending and retail sales generally. On the next slide, look at a 10-year chart of economic growth for the major current countries around the world. We are actually in red there, with China on the far right being above in green. And you can see things have kind of started to get back to normal after an incredibly disruptive pandemic and economic cycle. On the next slide, central banks have started to cut rates. That rate cutting cycle began earlier this month. The Bank of Canada was the first out with a 25 basis point rate cut. And the European Central Bank also cut rates 25 basis points in early June. The Fed has maintained its position higher for longer. Again, the strength of the labor market and the stickiness of inflation, at least in the first quarter of the year, has had them on a prolonged pause in terms of where they were. Remember, their last move was July of 2023 when they hiked rates for the final time. And they are now saying through the summary of economic projections or their dot plots that they're expecting one rate cut of 25 basis points by the end of this year. And the likelihood of that a rate cut occurring anytime before September is very, very low. Actually, I wouldn't be surprised to see. I actually think the bar for the Fed to reduce rates is very high. I think the bar for them to delay reducing rates is very low. So I'd expect them to stay higher for longer. And I wouldn't be surprised, although it's going to be data dependent, but I wouldn't be surprised to see them on hold until December. The next chart, you've seen this before. However, this is an altered chart. There are two major changes. Firstly, on the very bottom in purple, the Bank of Japan actually raised rates from negative 10 basis points to a range of 0 to 10, positive 0 to 10 basis points earlier this year. That was their first rate change since 2016 and their first rate increase since 2008, which is really extraordinary. More importantly, I think, though, the ECB recently cut rates. You can see that in green. They're at 375. You can see there's a slight little downdraft in rates, which was expected to continue. It's also interesting to note that the ECB actually cut rates based on forecasts of inflation and economic growth, whereas the Fed has been more likely to stay on hold and be data dependent as opposed to forecast dependent. On the next slide, a couple of things that Ed talked about a little bit. Long-term government interest rates have been higher during the year. They opened up around 3.85, 3.88% in terms of the U.S. Treasury 10 years. They were up as high as 4.70. They're now back down to about 4.25 today. So a little bit of volatility, but again, they seem to be settling in at lower lows more recently. Credit spreads, however, have tightened pretty considerably based on two factors. Firstly, there's an absolute stretch for yield. Investors look at rates of 8% or 7%, and notwithstanding the fact that they may not offer relative value on a spread basis, from an absolute yield basis, they are attractive. Also, the fact that the economy is cooling, and it does seem as though the Fed may be in the process of pulling off a soft landing, which means avoiding a recession and a spike up in default. So credit spreads have tightened as a result. On the next slide, we still have an inverted yield curve on top in red. That is the most current look at our yield curve. You can see the yield curve is an inversion is a fancy way of saying that short rates are higher than long rates. Look down to the bottom where it's in blue. You can see that's a normally sloping yield curve. It's positive and to the right. Typically, you expect to get paid the yield premium for taking on more risk by investing further out the curve. And you can see it peak on the far right-hand side. Those are 30-year U.S. Treasury issues right now. And the inversion right now is about 47 basis points. It was as wide as 110 basis points in this cycle. But this is the longest yield curve inversion we've had on record in history. On the next slide, just a look at where we are in 2s and 10s. 2-year yields this morning are 4.73 in white up top, and 10-year U.S. Treasury yields in green this morning again, 4.26%. Credit spreads on the next slide that I talked about a little bit, and Ed touched on. You can see high yield spreads in orange compressed down to just about 302 basis points. That's actually up a slight bit from where they were when we reported last quarter. And investment grades credit spreads are under 100 basis points. Not really compelling, but again, that stretch for yield. And again, the narrative of the soft economic landing, I think, is certainly driving. On the next slide, this actually gets more interesting. Our returns in equities have been incredibly concentrated, and I term this the market having bad breath, meaning that it's very, very concentrated in terms of its returns. Right now, if you look at the top 10 S&P 500 stocks, they are now 38% of total market capitalization for that fund. And I refer to this as mega cap exceptionalism. Everyone talks about U.S. exceptionalism, the outperformance of the economy, and particularly our stock markets. But again, a lot of that's driven by this artificial intelligence investment super cycle I talked about earlier. If you look at the top 5 stocks in terms of driving returns for the S&P 500 year to date, the average 1-year earnings per share growth has been 84%. Those companies are all tech companies. It's Microsoft, it's NVIDIA, it's Google, Amazon, and Meta. And again, if you look at the percentage of the S&P 500 that's designated information or technology, it's about 1/3 of that index. So again, very concentrated returns associated with this artificial intelligence investment super cycle. On the next slide, just look at benchmark returns. Ed talked about this earlier, and the only real line I'd call your attention to is up top. U.S. equities in 1 year delivered a return measured by the Russell 2000, 29.3%. That's a phenomenal run-up. And again, that's due to some of the reasons why, on a relative basis, PE, again, private equity looks like it's underperformed. But again, that's an extraordinary level of return for the Russell 2000. Treasuries continue to suffer a little bit with the backup in yields. Anything with durations got hurt the last couple of years, although we're starting to see some advantages of a declining rate across the curve. On the next slide, just a look at where equity prices are shaping up. And here you've got the year-to-date returns, and then the year-to-date returns in currency. I'd say the only one I'd look at is really focus on is European markets and France. Last week, given the decision to hold snap elections in that country, took a positive return and turned it negative in local currency terms. But otherwise, a lot of green on that screen. On the next slide, a look at higher sovereign 10-year Treasury yields. You can look at the far right-hand side. All those markets, all those 10-year sovereign debt issues have pluses next to them in terms of the yield change. And as yields go up, prices come down. The only exception is China, again, which is suffering from a little bit of an economic slowdown in Treasury yields, or the equivalent of Treasury yields for 10 years in China come in 25 basis points. But again, that's why we've had some headwinds in bond prices trading up and continue to sell off. Maybe 2 slides ahead, Kate, just in terms of recent news. This touches on some of the things, remarks that Anash made earlier in terms of private equity distributions or exits. They're still only about 25 to 30% of where they were in 2021 levels. Those were really phenomenal levels of exits or distributions. I was reading something over the weekend that talked about DPI being the new IRR. That's just a fancy way of saying that distributions and exits perhaps have to run the risk of taking priority over returns. I don't think that's necessarily the case, but it is something the market is talking about. I also think that the private equity exits and the lower level of exits for fire pension plan is not as big an issue as for some of the other public pension plans out there. Our allocation's lower. You just increased your allocation to private equity. So through a pacing plan, we're looking to put more money to work in that space, as opposed to relying on distributions for liquidity, or having an overweight position above your target stress levels. One of the things that Nash talked about earlier, I think that was part of your question, Ian, was really about the slowdown in bear market, M&A really 2022 to 2023. But mergers and acquisition activity has picked up about 8% to date, primarily focused on tech and energy. And the next slide, just food for thought, really talks about the how private companies greatly outnumber public companies here in the States, and the importance of private markets to the U.S. economy. The note up top talks about 87% of U.S. firms with revenues greater than $100 million are private. If you remember, we had the privilege of having Robert Smith from Vista speak at one point, mentioned 98% of all U.S. software companies are private. Again, that's why you have an allocation, significantly increased allocation to private equity forward. On the next slide, just a look at how small businesses on the far left-hand side, you can see that those institutions that employ anywhere between 101 and 249 individuals are almost 80% of the economy. Looked at another way in the next slide, only about 18% of those individuals employed by the S&P 500 firms are working in the U.S. economy. We have a total workforce of about 158 million people. Again, only 29 million of those, only I should say, but it just shows that the importance of, again, private markets relative to public markets in our economy. On the next slide, this is actually a 33-year chart. This is a new chart that actually looks at the S&P 500 share the top 10 companies by market capitalization. And you can see where at one point it peaked in the early 2000s, slightly before that, at about 26, 28%. It's at 38% today. And again, that is a little bit concerning because it looks at a very concentrated increase in concentration among the S&P 500 performers. You'd like to see more breadth. You'd like to see that widen out. We saw a little bit of that earlier this year. And again, concentration in the run-up in stocks has been really more focused on a few names in the second this year. These names are Microsoft, Apple, NVIDIA, Amazon, Meta, Google, Broadcom. And the other three that actually follow up, and again, comes to size, are Berkshire Hathaway, Eli Lilly and Company, and number 10 is JP Morgan, the one financial as well. This is referred to as American exceptionalism, a relative valuation disparity. Again, the artificial intelligence super cycle of investment in again, the first 7 of those companies, as well as called mega cap exceptionalism. These are things you're probably reading and hearing about in markets. On the next slide, just a quick look at where we're going in terms of rates. And you can see where we were on the far left-hand side of this chart, where we had negative rates in Europe. It's in the bottom in green. You can see how the U.S. SOFR, the replacement for LIBOR, is barely above 0%. You can see the step up in Fed funds in the gray bar as it moves up and moves higher and stabilizes up top. But the interesting thing about this slide is on the far right, it indicates that right now market expectations are for rates to remain higher, at least through the second or into the second half of 2025. So there won't be a quick reversal when the Fed does start reducing rates. They're not going back down to the zero bound. Right now, the neutral rate of Fed funds, as put out by the Fed in their summary of economic projections last week, indicates that they think that the neutral rate of Fed funds that's neither restrictive or accommodative is about 2.75%. I suspect it's closer to 3 to 3.25%. Time will tell. Slide. Some of the things we've talked about in terms of the painful yield and the negative impact on fixed income returns. Here's the good news, though. If you look at where these light blue diamonds are across every sector of the rates market, the bond market, the current yields are um, just a couple of years ago. You can see that's the average return for the last 10 years. So on the left-hand side, right now, rates are 4.5%-ish, whereas where average 10-year treasury yields were at about 2.1% before that. So again, I think that's positive in terms of having investments that will power the yield and performance of the portfolio over time, although it's been a little more painful to get here than we would have liked. Let's skip the next slide. Next two slides, actually, Kate, if you would. One more. Again, this the U.S. concentration risk. The S&P 500 today is almost 40% of the global equity market cap. If you can look at where it was, say, during the global financial crisis, 2008, 2009, closer to 30%. So that's quite a run up in U.S. stocks relative to non-U.S. stocks. Again, I don't know that that's a healthy development. I don't think that Europe or the rest of the world really has types of institutions like an NVIDIA or a Microsoft or an Apple that are really on the same scale and size. Those are all $3 trillion market cap companies. But it's not to say that there aren't very good companies abroad that have underperformed the U.S. market recently. See, next slide. Just a look at secular stagnation. I talked about the demographics and people retiring. This on one more slide, sorry. Yep, on the far right hand side, this 2,100 a year. So it's again looking at 76 years. But you can look at the decline in the percentage of those people that'll be working in the labor force. So again, it just that will be a little bit of a headwind. Retired people tend to spend a little less. They earn a lot less. And again, they will not be actively involved in supply and labor market. Maybe 2 slides ahead, Kate, please. This actually looks at the share of mortgages that are actually the share of homes that are owned in the marketplace today are almost 40% have no mortgage, which means that it's been a little bit of a headwind from the Fed raising rates dramatically to reduce to slow down the economy. When 40% of the homes don't have a mortgage, I think that's been a positive. On the same scale, in the next slide, about 63% of all the mortgages that are outstanding today have levels below 4%. Again, they became assets. That mortgage rate below 4% is something you wouldn't run a really swap for 7.25% today. And that's made the Fed's policy less impactful over time. That's why it's taken them longer to get inflation down.
So in theory, do homeowners run the risk that at some point they have a stranded asset and nobody can afford? So it's great if your house is worth $1 million, but if nobody can pay $750 for a house, then who's holding the bag,
Yeah,
right?
if rates are stickier and they're
Yeah.
higher for longer and we're not getting back to where we were pre-pandemic, maybe on the next slide, this kind of answers the question. This is the expectation that people have for the increase in prices of their home over the next 5 years. So on an annualized basis, a lot of people think that they expect to see their house appreciate 4 to 5% every year.
But is
part of that is
realistic, right?
well, there's not a lot of supply out there, so we don't have enough houses to meet demand. But affordability is a real issue as well. You can't have houses just going up in value, particularly when mortgage rates are so high. So I think that's a chance. One of those markers that can kind of has you scratching your head. And on to fire performance reporting. Kate, maybe 2 slides ahead. Now we get into the meat of the presentation. So we've been trying to work with different formats in terms of displaying your returns. The good news is there's a lot of green on this screen on the far right hand, on the lower far right hand side. Obviously, Fire's public pension plan is in red, and you can see how it's stacked up relative to your policy returns. Again, your new strategic asset allocations, where public markets are with a 65-35 split. And again, relative to the TUCs, I think the takeaway here is looking at again out 5 years, if we like to have a longer view. But your plan is exceeded at 7%, actual assumed rate of return is 7% at 7.9%. It's underperformed some of those benchmarks, but remember, you continue to deploy money into private assets that takes a while to ramp up and impact the return. On the next slide, real quick, what you want to see is that red above that blue line. So that actually is if you invested $1,000 10 years ago and earned a 7% return, you'd hit the blue line. So you're slightly above that, slightly above outperforming that target. Again, that was reflected in the prior slide. But that's just a different way of looking at how we're trying to achieve 7% over time and our success in doing so. On the next slide, I'll look at FIRE's net public market returns by strategy. Similarly here, we've had a little bit of challenge in core fixed income, but for the first quarter of calendar year 2024, stocks are up 10%, developed market ex-US stocks up 4%, emerging markets up 3%, all green. Fixed incomes had a little more challenge. TIPS, which you've divested from, is flattish. High yield has actually outperformed because of its relatively low duration, which is half of the Bloomberg aggregate in terms of its size. Also, yields are higher and spreads have tightened. On the next slide, I'll look at your excess returns in the public markets. Here you've generated a net excess return relative to the Russell 3000 for the quarter, 17 basis points. Developed market ex-US equities have underperformed. And then down the line, you can see it's been a positive performance again in the public sector across the board for the quarter. On the next slide, one last slide before we transition over to private markets, just a quick look at the fees you pay. We're trying to provide more insight. We've got a lot of initiatives trying to give you more insight into fees. This is more or less a meat and potatoes look. So the fees you paid for your public markets management in the first quarter were about $5.8 million. 77% of that $5.8 million is for equity management and about 23% of the balance being fixed income. This equates to approximately $23 million worth of annual expense a year for managing your public assets. The other takeaway from this slide is on the far right-hand side at the very bottom. That is the average fees you're paying for all public management at just 16 basis points. And again, we want to track that. We want to improve on that. We want to provide more transparency around the relative value you're getting for those fees over time. So that's all.
And Steve, I just want to make one suggestion on this slide, which I think I made in another system, that all strategies combined, if we could just say all public strategies combined, just in case this goes up on the website, somebody's going to
Got it.
say,
Fair point.
Yeah.
Sure.
Emerging markets are always, and again, it always go back. I know it's a diversification or to lower data. It just seems like it's always long term. Is that ever a consideration to limit or reduce?
Yeah, I
Some
mean, it was
exposure.
for emerging markets. It had a tough pandemic. You're absolutely right. That observation is correct. But if you look at over a longer time, say 25, the number of emerging market experts your top. So again, I tend to buy into the idea of American step. Yeah. You have to look at the relative valuation. So I have a statistic. So right now, if you look at the S&P 500, the forward-looking price earnings ratio, based on how much you're paying for a unit of earnings, about 51, about 13 emerging. So the valuations are a lot lower. Looking at it, U.S. looks expensive. Question is, how does that? Actually, I think a lot of the emerging market economies better 2-3 decades ago. So you have a relatively small allocation. Remember, you basically finance the increase in private assets, like equity, in development. But that's I can't argue with the observation you have. Question: when will they be? Yeah, very much so. I mean, the US is a great economy, but in the world, we've got great internal markets, got, liquid and deep financial markets. There's a lot of really good things. We're the most innovative entrepreneurial economy. And a lot of really good things, strong response. But at some point, you have to ask, look at that price. And when I look at those prices, of 40% local market, that tells me there's a lot of really good news priced into that price. I do think on a relative value, I want to look at some first. Ed raised some really good points, a number of good points from his presentation, but there could be something out there that could take the market. There are
Going into US, it's always like between the mutual investment for case. So is that always officially or really?
well, the market had, but with short term, sorry, with time, like high yield bonds, seven starts to look like an alternative track. I don't think equities is any longer the only game. But you're right. I mean, the market, that's a fancy way of saying it's a lot of money, but that's value. Again, one of the things, if you don't kind of, you're too big, it's hard to do. Most people are not effectively. So for us, it's really have earn money, invest time in. Again, the choices input that you have see the strategic allocation takes into consideration fact what do we think the likely returns is what's the correlation price quality all that kind of together into a nice portfolio that we think will achieve that 7%, the higher. I don't know if that's a some answer to your question. Those are good
More theoretical
observations.
than
No, those are great questions. You have to scratch your head and say, wow, this is great. Look at those. US market done really well. I said, I still think that American acceptance still has a reasonable tax. Again, for me, it's I buy all that, but how much is already priced? I think a lot is priced. I'm talking out of the other side. Look at what's going on with artificial intelligence. There's just so much going into it. You could say that although it smells like the 2000 when the internet bubbles, these are real companies with real earnings. Tremendous amount of so it's very different.
To turn.
Yeah, what, it was,
Sorry.
it was, oh, and that was the wisdom.
monetizing AI.
Yeah. Well, again, the super cycle, no one knows how long it's going to last. So at some point, I suspect it's overdone. But everyone is now investing in infrastructure to support artificial intelligence. A lot of other countries are quickly starting to develop the technology and bid up the chips and need the software, need the infrastructure. So, and one of the things we'll talk about is how is artificial intelligence impacting your portfolio in so many different ways. It's not just NVIDIA and chips, software companies, both private and public. It's data centers. You actually buy data centers to get data center exposure through private equity, through infrastructure, real estate. It's sources of energy. You know that artificial intelligence uses 10 times the amount of electricity that the cloud does. So, I mean, there's a lot of those facilities that are obsolete because they don't have proper cooling. And I mean, the infrastructure build is going to be fantastic. Maybe for the next 3 to 5 years. I also think the acceptance and deployment of the technology, like do you use artificial intelligence in your day-to-day life? And I don't mean to put you on the spot. I use
Yeah, no,
ChatGPT 4.0 was
Yeah.
like starting to become more common, but it's still,
Gemini, they.
Yeah.
So easy.
but I think, when it's fully, and who knows how long it takes to scale, but 5 to 10 years, it's going to have a dramatic positive impact on a number of things. It's probably going to be disinflationary because it's going to boost productivity, and it'll boost GDP. and your guess is as good as anyone's. I'm looking at Dr. Berman over there. 1%, 1%, no one knows. But it will have a positive impact on not just US, global GDP growth. And those are the things we look at, the impact, like all these things, like, you know, how does it impact inflation? How does it impact growth? What's the impact? So it's a fascinating time to be in the markets and trying to assess this. Maybe I'll have a couple other more recent.
And perhaps one of the, well, leadership speak. Developing. Yeah, it's like
Yep,
a little bit
yeah,
more than.
yeah.
We've scratched the surface.
Last
And we
Friday.
touched on it last Friday, but I think,
Jumped in on Friday.
but I think you're gonna
Actually,
see
looking
more
at
of, I think it's become the common theme of all of the presentations, but I think at some point it really starts to dominate those conversations. Because it's,
Yeah.
it is the thing, you know, it's the next, you know, the next step for people kind.
It does seem as though the greed is continuing to rule the day. So, I mean, the valuations are high. I think, I mean, but again, these companies are profitable. They're generating tremendous levels of earnings and free cash. So you can't argue with success. At some point, I talked to someone recently, and he said that he thinks NVIDIA is going to be one of the greatest shorts of all time, but he doesn't know when. He said that might not be for another 5 years, and who knows what the valuation will be then. We basically have three of these mega companies that are $3 trillion market cap stocks, Microsoft, Apple, and NVIDIA. That's, I mean, think about how much bigger they are than most of the world's economy.
Even though narrow.
Yeah, that's why I said, you know, it's kind of a joke. No one ever even smiled, but the market has bad breath. You say breath, but it's breath. It's BREAD.
Hold on.
It means it's not wide.
You know
It's
what, I
very
just-
concentrated. I gotta take that. But it's not a good development, and it's highly concentrated. And again, if you look at even the top, they said 7 stocks in the S&P 500. They're all tech. They're all touching AI, and they're all doing well. The one that dropped out is Tesla. So again, I think they were perceived to have been falling behind. There are other issues. Yeah.
Okay, we're heading into an interesting world of retail. No, you know, the lack of publicly traded companies, or I should say, trajectory downward, the number of publicly traded companies. The fact that institutional investors, like this fund, by the way, benefit from being institutional investors. And if you look at the holdings of a lot of these companies, they're really held by institutions rather than individual investors. I think it's really kind of interesting because I believe there was a generation of people that contributed to their own wealth to being able to buy individual stocks and invest in the market. And I think that that's changed. And I'm curious how that plays out for retail investors and people on the street that don't have the reliance of a public pension plan or any pension plan, and really have to you know, supplement their retirement purchasing stocks and bonds on their own without any advisors or any of the folks that we have BAM, or we have you know, access to compensation plan for things. So I think it's a really interesting time for retail investors as we look at the markets, because the markets aren't just us. We are incredibly big.
Yeah. Some of the regulation around, like, say, Dodd-Frank in terms of disclosure and all that, were a bit overbearing. If you look at 20 years ago, we had over 8,000 publicly traded companies, stock. Now it's a little over. A lot of those have taken private. A lot of, I think, also private for longer, Anash. Correct me if I'm wrong, but that's a theme. There's a lot of benefits associated with managing a company on a private basis. The better alignment of incentives with the management. There's a number of lower regulatory reporting burden. A number of things that would impact and have impact on a relative basis. I think going private or staying private is an advantage. One of the things, Anash, you may want to comment on, but we hear all the time about private equity firms buying buying companies from other private equity firms. And does that seem to be churning, or is there a reason for that? I mean, how does that, when you think about the daisy chain of things that occur in private equity, kind of walk us through that.
Yeah, just to respond to your question about regulatory requirements. I think one of the main differences between being public and private is that when you're a public company, you have to report for the results to shareholders. And those shareholders oftentimes may be more short-term oriented. Whereas in private markets, you think in years and decades as opposed to quarters. And in many instances, that allows the management and the owners to implement more strategic initiatives that they otherwise would have a harder time doing, being in the public domain. And I think as a result, you've seen just so much growth of capital around the private markets, and we think that that continues. In terms of assets being sold from private equity funds to private equity funds, I mean, that has been a trend for a very long time where smaller funds sell to larger funds because they found a smaller business, they grew it to a certain level, and now they don't have the experience to, let's say, internationalize it or, introduce it to different customers or expand it in new ways. So there are legitimate cases where a new owner can do something different and better with the business. And there's plenty of proof points in your portfolio where not only a small manager sold to a larger one, but in some cases, a large or a comparable sized manager bought the same company and just had a different perspective on where it could take growth. So we don't necessarily see it as a bad trend overall. And one of the things we always look for is alignment of interest, making sure that managers are putting a healthy GP commitment to their fund, that they're aligned with our interests by putting skin in the game, et cetera. And so I wouldn't say it's a troubling trend. There was a point in time, maybe 10, 15 years ago, where it was more newish and people had lots of questions about it. But, plenty of your managers in your portfolio have made very strong returns, even buying a company that was previously owned by one or more sponsors.
Can you stay here? I want to go to the private assets, and you may have some comments as well.
Okay.
We get back to the slides, Kim, or Kate? Maybe it's one slide ahead, just to look at our net private manager returns. Again, you can see up on the left-hand side for the year, pretty positive across the board with the exception of real estate. Core, non-core real estate has actually underperformed relative to price dislocations associated primarily with office and retail space. But again, that trend continues to play out. Notwithstanding that comment, though, if you look on the far right-hand side, the net private manager returns have been incredibly positive, again, for a prolonged period of time, which is really healthy. On the next slide, a look at excess returns. And again, I wanted Anash to sit at the table, not to make him feel bad, but the one-year return for private equity relative to the Russell 3000. Again, remember, the Russell 3000 over last year is up 29.3%. It's an extraordinary run-up in valuation. So even if there's an underperformance, it still reflects that private equity now has got about a 10-11% return, which is not bad as it's come through kind of a challenging, again, that bear market in M&A. So good returns. Again, focusing on where we should on the far right-hand side, 10-year returns across all asset classes look very, very positive. On the next slide, and I'd love it if you could comment on, this is a work in process. What we're trying to do is provide you with a little more insight into how much money you have invested in the ground, and how much you've already committed to that has yet to be called. And this is the good work that Anash and his team and the specialty consultants do in terms of coming up with a pacing plan that incorporates all the things that they're thinking as well. But looking at private equity on the far left-hand side, the position is a little over, in aggregate, it's about 2.9 billion in size. Right now, in gray on that left-hand pie chart, you've got 1.8 billion, a little bit more actually invested in the ground. But you've already committed to another 1.1 billion that is yet to be called. So Anash, any comments?
Yeah. So this is actually not a surprising ratio, and it's fairly consistent. So if you look back here, you always have a pretty big chunk of total exposure in the unfunded commitments. And when we go through the pacing exercise of StepStone, we always look at all of the funds that have already been committed to the unfunded to be called over time with a pacing recommendation for your plan. Last year, we were a little bit more conservative in how we modeled the pacing plan, given that distributions have dried up a little bit recently, so we can't expect the same level of distributions as we have historically. So despite the fact that the plan increased its target to alternatives and PE more specifically, we were a little bit more conservative in modeling how those unfunded commitments, which are going to be called, are going to be offset by distributions, which are a bit slower. So again, nothing really new here other than just showing it on the page, but the unfunded to NAV ratio has been fairly consistent over time. And it's just a feature of investing in private markets.
So, by the way, here,
It's in public market part. So for Nash, it's in Russell. It's in a combination structure, it's in a combination global equity. It's again, Petra's book, infrastructure book is 45% non-US. So it's in global stocks. It wasn't TIPS, it wasn't consumer gag. Obviously, with TIPS going away, we're rethinking what's sort of the benchmark. For real estate, it's a combination of equity, Bloomberg Ag exposure, and income. It's a combination of high yield and loans. I should probably move more to a high yield mandate there. The one thing that kind of jumps out a little bit to me on this slide is your opportunistic fixed income, and overseen by the private asset team, but Tina Sue in particular. And there is something that it's a little different. It's more of a nascent. It's not as established in terms of your investment in it, say relative to say private equity. It's a little different. So most of the other structures have investments in general partnerships to LPs. Your book for fixed is mostly separately managed accounts or SMEs. About 70% of that. One of the comments that Doug Mosley at NEPC made about deploying capital more quickly in private markets. I think that's a good strategy. That's actually been done to some extent, and not to disregard the pacing plan, but with the focus on separately managed accounts, you're able to ramp that up quickly by doing add-on. Aries, Apollo, Fulfill Advisors, recent group as well. So again, more to come on this. We want to be much more transparent, give you guys more information in terms of how your portfolio is being managed and developed. And the last slide I have before we conclude is just what we've done over the quarter in terms of rebalancing your portfolio. Again, the bulk of these activities were really to support a transition to your new strategic asset allocation plans, which are largely done with the exception of private markets. That's through a pacing plan. It takes over time. But here you can see you were liquidating about 2.5% your holdings in, or the total portfolio was in U.S. equity, reallocating that into some non-U.S. through a normal rebalance. You divested from TIPS. You increased your exposure to high yield by 1%. You also increased your exposure to core fixed income as well. And last but certainly not least, on the very top right-hand side, cash. So you raised $220 million to meet benefit payments.
And while we're in public, let me reiterate, we've never missed a payment. We're not planning to anytime soon. So just remind everybody, when you see this number moving, it's because we're paying them.
Great. Any questions on that? I know I tried to be brief. I don't think I was, but I threw a lot at you. I didn't cover.
Okay, so that concludes the public agenda. I'm going to make a motion that we exit public session and enter into executive session.
Second.
Opposed? Hearing none, the motion carries. We are entering into executive session. Please turn off the session. Thank you. Now that we are in public session, I need a motion to start the firefighter variable supplement fund meeting.
So I'll make a motion to exit public session of the fire pension fund and enter into the firefighters variable supplement fund.
Second, Bob Eustace.
Any opposed? Hearing none, the motion carries. We are now in the firefighter variable supplement fund meeting. The board is requested to note the receipt of the quarterly reports.
So,
Oh,
Oh.
wait, we should do a roll call first.
Representing Mayor Adams,
Kevin Liu, present.
representing Controller Brad Lander,
John Dorsett, designee for Controller Brad Land.
representing the Commissioner of Finance. And this is the firefighter. So for the UFA, Mr. Robert Eustace.
Present.
And Mr. Christopher Viola. Present. We have a quorum.
Excellent,
So
thank you.
I would like to note receipt of the quarterly report.
Thank you. So noted.
And with that, I'd make a motion to exit the firefighters variable supplement. Fund.
Second, Bob Eustace.
Okay. Oh, and enter into the fire officers variable supplement.
Excellent. Any opposed? Hearing none, the motion carries. We are starting the fire officers variable supplement fund meeting, and we will start with a roll call.
Once again, for Mayor Adams,
Kevin Liu, present.
for Controller Brad Lander,
John Dorsett, designee for Controller Brad. Land.
for Commissioner Nyblak. And for the UFOA, Mr. Joseph Camastro and Mr. Liam Guilfoyle. Here. We have a quorum.
Excellent. The board is requested to note the receipt of the quarterly reports.
So noted, and I will make a motion to exit the public session of the fire officers variable supplement fund and enter into the public session of the firefighters variable supplement fund.
Second, Liam Guilfoyle. That was fire officers.
And enter into the fire pension.
And then third,
Okay.
five hundred. Yeah.
Excellent.
So-
Any opposed? Hearing none, the motion carries. Thank you. We are now in the public session of the Fire Pension Fund. During the executive session, the board discussed various investment matters. I would now welcome a motion to adjourn.
So moved.
Second, Liam Guilfoyle.
Any opposed? Hearing none, the motion carries. We are adjourned. Thank you all.
Thank you.
Thank you.